Hey everyone, this is Rahul with the Alternative Investors Hangout, and today we have a new guest. He is Andrew Abraham. He's over at Trend Following Mentor, and he also has a YouTube channel, which I follow him on, and it's simply his name, Andrew Abraham. Thanks for coming on, Andrew.
Thanks for having me.
Okay, one of the reasons why I wanted to get you on is you're mainly in technical analysis, or you follow that. I usually follow fundamental analysis, but what we came to a similar conclusion, or what we followed, is that there's a lot of bullish sentiment in the market, and there seems to be a lot of margin debt. So what do you think about that when you see all of these bulls out there, and does this remind you of 2007? Not necessarily that there's going to be a crash, but what's your thought process behind that?
I think, well, as any trader knows, the herd is always wrong. And, talking about YouTube, I put up a YouTube video this morning because today's a quiet day, and I talked exactly the opposite about bonds and interest rates, because the general consensus, again, is that interest rates are going up. However, there's signals that I'm getting because I'm a technical trader that, and again, just following the trend, that the interest rates are falling back a little bit. So, again, when you trade, you have to always go with this belief that anything can happen. And you don't trade what's the word I best want to say is you don't trade your opinions. You just trade what you read what the market's telling you to do and keep to the plan.
And then what about the stock market now? I mean, do you see a similar situation to 2007 then, or 2000, where you see all these bulls?
Well, I'll tell you a couple things. I mean, you mentioned fundamental. I'm also, let's say like this, I think when you trade the stock market, you have to be almost a hybrid of a fundamental and technical. And that's why I like a lot of the work of Investor Business Daily. And they combine the idea of buying the strongest stocks in the strongest sectors and in the new products and all of this. And then you combine the technical. But one thing they have, which is fascinating also, which is technically approached, is that you look at the volume on down days, or they call them distribution days. And what signifies, or could be signifying, a potential top is when you have clusters of these distribution days. And currently, I believe we have 6 of them. So again, if you're combining all the, let's say, pieces of the puzzle, the absolute bullishness was about 61.8 of running by Investor Survey on financial advisors. That's an extreme high. You add in the margin debt, that's also extreme high. You add in these distribution days. It's, you're just trying to read what's on the wall. And in conjunction with that, I just use simple moving averages. And when you do that, you're going to stay on the right side of the market. It's not going to be perfect. You're going to have some whippy trades. Sometimes you're going to get whipped around. But in general, you're going to stay on the right side of the market.
Moving forward, I wanted to go into what your book talked about, and apparently you had some money with MF Global, and we know what happened with that a few years ago. And basically, I also read that you had some money at the Treasury Direct, so that basically covered your rear end. And what I like about your videos is you talk about risk management just to cover your tail, just in case the worst case scenario happens. Could you elaborate more about that? Because I have a lot of newbies on my channel, and I think it's really important to learn about risk management.
Well, let me first qualify that I think MF Global was like a Six Sigma event, and the same with PFG. Very few people anticipated it, and even if it happened in the past, when you had, it was the other fund that blew up during the Refco, people got their money the next day. So this was a very unique situation. It was an absolute breakdown of, let's say, trust and confidence. I mean, our monies were stolen. So, certain things you can try to avoid, and other things you can't avoid. And the other thing is also, like, when you're talking about risk, you can never avoid losses. You are always going to have losses. You're always going to have drawdowns. And the truth of the matter is you're going to have durations of drawdowns, which aren't fun. And even, let's say, series of trades that don't work. And when you try to avoid them, you end up losing more money. So I always try to tell people that you try to risk a very small percentage of your account on any trade. Like, it's risk per trade. Let's say if I'm trading, let's say an easy number, I'm trading a $100,000 account. I'm not going to risk more than $1,000 or attempt to risk more than $1,000 on a trade. In most cases, I'm trying to risk even less. But even that's not perfect because trades can go obviously against you. You can have gaps that there's no control over. And I had a gap trade in this stock was a leading stock, ARMH. It just gapped down. Even though I was risking only 0.5% of my account size, it was a little bit bigger loss than I anticipated, but that happens. So you always need to have a risk management plan as part of your trade plan, and always under trade because there's going to be things that go against you that you can't control.
That is indeed the case. And one of your, not plans, but I remember seeing one of your videos, and you always talk about if you have a profit of more than 20 to 25%, one of your rules is that you look at the 50-day moving average, and as long as it doesn't go a percent below the 50-day moving average, then you're going to get out. Could you elaborate more on that? Because I think some people need to
first of all,
have some.
Everyone has to make up rules that pertain to themselves. What worked for me might not work for others. And what I do is I trade various types of systems, and each of those systems have different exits. This one that you're referring to is basically the stock system of like IBD. These aren't my rules. These are their rules, and they're very good rules. And what they say is that once you have a 20-25% profit, they suggest you take some of that profit. Again, it's up to the individual trader to decide what they want to do, because the whole idea of let's say IBD is then they have these cups and handles that stocks will run up on average 20-25% and then base out again and form another cup. So that's why they suggest taking those profits at those points. But then again, it's Murphy's Law. There's going to be some stocks that just keep on running. But the idea, what I would suggest, what I do in mine is I look to scale out partial of my position after a 20-25% profit, and then my ultimate stop turns out. And also, you're just watching what's happening. Also, you're watching the volume. Let's say if you have some down days or reversal days on big volume, you look at it and you say, well, maybe I should take a little bit more chips off the table. Let's say it's like you want to be flexible to some degree, but also rigid in others. But the absolute, let's say, line of demarcation, again, would be the 50-period exponential moving average. And then again, if you fall 5% below it, you exit. But, you can also say, when I'm saying flexible, let's say you get a lot of distribution days in a cluster and the market really starts selling off and your stock still, is holding up. You might want to tighten up your stops. Again, there is no absolute right or wrong. So you have to be, again, to some degree flexible and really watch what the market's doing. It's not easy. It's very tough.
I agree that market is really tough to figure out. And before I let you go, how can people follow your work again?
Well, on my blog, I have a blog that every day I try to put up a short, either a video or a short piece to educate. And it's kind of my way of giving back. I had people help me all along the lines. I had, one gentleman who started in 1979 and another one who started in 1982-ish that really taught me, not any magical formula, but they taught me how to think. And the psychology is really the key, and the idea is to have a trading plan. So what I do is on my blog, it's trendfollowingmentor.com, and there's a blog on there, and I just put ideas that hopefully people will learn from. And that's really what the whole idea of the website is. And that's why, with the YouTube videos, I just hope it makes a difference and helps people.
And then you do have a YouTube channel at Andrew Abraham, correct?
Yeah. And then, again, my book, I'm not really, banging my, the book. The book has really been, I get all kinds of emails from people all over the world. I wrote a book called The Bible of Trend Following. And it, again, if you're whatever type of trader, if you're a Forex, you're a stock trader, a commodity trader, there's lessons in there which kind of talk about, the trading plan and how to build a trading plan, and then, how to make sure that it fits your personality, how to follow it, the trading psychology. So a lot of people have been emailing me, and really the book has really helped them. So maybe possibly you want to pick up the book. That could help too. But and also I'm available. If you want, you can email me, and I'll try to help whoever emails me. And it's just Andrew@trendfollowingmentor.com.
All right. Thanks for coming on, Andrew.
My pleasure.